are you ready to roll? All right. So I will call the meeting to order. Good morning, everybody. Good morning. Today is December 17th. It is a beautiful Tuesday here at 335 Adams Street. This is the NYCERS investment meeting. Madam Executive Director,
Here.
please. Here.
Controller's Office.
Here.
Public Advocate's Office.
Here.
Borough President Manhattan.
Here.
Borough President Brooklyn.
Here.
Borough President Queens.
Here.
Borough President Staten Island.
Present.
Borough President Bronx.
Here.
International Brotherhood of Teamsters.
Here.
Transport Workers Union.
Here.
District Council 37.
Here.
We have a quorum.
Thank you. We have before us the agenda on page 1 of your booklet. Does anyone have any changes or additions either to the order of the agenda or any additional items?
So we'll have an item in the executive session.
Okay, so there will be one additional
One
item
additional
to the
housekeeping,
executive.
what I would describe as a housekeeping item in the executive session.
Okay, very good. I believe there was also another request for an item in the public session.
Oh, yes, this is a resolution, shall I read?
Do you just want to add it? We'll
Yeah, we'll
perhaps
add-
do it. We'll
yeah.
add it to the agenda. There's a,
Yes, there's a resolution to be added to
Okay.
the executive.
and
to
shall
the-
we add that as the third item? Is that acceptable?
Yes,
Okay.
it's acceptable.
All
Thank
right.
you.
Thank you.
No objection.
All right. Everybody is in agreement? All right. So thank you, everyone. And that, I will hand it over to you.
Thank you. I will hand it over to Seema for the discussion of the September quarterly.
Thanks, Dad. So we're going to talk about the September quarter, which is looking back a ways now, and then we'll go into the October monthly and update you on where we are today. But let's start with the quarterlies, and I'll turn it over to Martin.
So before we go in, thank you, Seema. So before we go into the numbers, just want to remind you about the context of the September quarter, which was an excellent quarter, as you'll see. Again, the first quarter in the fiscal year 2014. Just prior to the September quarter, at the end of June, you'll remember that the markets were in turmoil because of the concerns over the Fed's tapering decision, which is the slowing down of the bond buying program, which ultimately led to higher interest rates and a decline in risky assets of all sorts. In the September quarter, even starting in July, the markets seemed to calm down, just coincidentally right after the end of our fiscal year. For the quarter, we had some remarkably good returns in risky assets. U.S. equity market up over 6% for the quarter and over 20% for the one-year period. EFA did even better, up over 11% for the quarter and well over 20% for the one-year period. Emerging market equities, you've been seeing some negative returns. We now have a positive quarter over 5%, which obviously helped. In fixed income, long-term rates rose or inched slightly higher, so there are very small positive returns. But in the riskier, more equity-sensitive areas in fixed income, such as high yield and convertible bonds and certainly opportunistic fixed income, the returns were very, very strong. So now if you turn to page 7, I want to start by pointing out the market value number on the top, which would be an all-time high for quarter end of over $48 billion for NYCERS. The numbers are shown in, we have extra copies here if you need,
Of the quarterly?
of the quarterly.
Yeah, the quarterly book.
Yeah. Everybody have a Swiss book?
Yes.
Okay, great.
The first two columns on the left are identical because the fiscal year to date is the first quarter, and you'll see the numbers on an absolute and relative basis are good, returning over 4 3/4%, well ahead of the policy benchmark. And the one-year number you'll see very strong at over 12.5%, also well ahead. The 3-year number, 10.5% even, 11 basis points behind. And going back 5 and 10 years, strong numbers, slightly behind for the 10-year and 40 basis points behind for the 5-year number. We'll go into attribution in just a moment. The next 2 pages show the asset allocation and where the funds stood, where the assets were invested versus the policies. And this you saw last month. and Seema will have an update for October in just a moment. So if you turn to page 9, this is the adjusted numbers, meaning where are we versus the adjusted policy, taking into account the fact that some asset classes aren't fully invested. And the overweights and underweights are plainly visible here on the left side, and they have been for about a year now. We're overweight U.S. equity, and we're in the middle, underweight core fixed income and tips. In an environment where U.S. equity did very well and fixed income did not do very well on a comparative basis, each of these overweights and underweights helped, as you'll see on the next page, on page 10. The return of 479 had both positive allocation and management effects. What that means is the allocation effect is due to deviations from the policy, overweights and underweights. And as you saw on the previous page, the overweight to U.S. equity, which did very, very well, and you'll see the precise numbers when Seema goes through it in a moment, added. And the underweight to tips and core plus 5 added because those underperformed. Any cash that we held would have hurt. Fortunately, we had very low cash balances. As far as the management effect, and Seema's going to go through this in a moment also, that refers to how managers did themselves versus their own benchmarks. The biggest standout would be U.S. equities, and that's on the positive sense. U.S. equity managers overall did very well. Very, very similar numbers, but to a greater extent for the one-year number, and that's on the next page, 12 months ending September 30th. The overweight to U.S. equity, the underweight to core plus 5 and tips all helped because U.S. equity did well for the year, very well, and core plus 5 and tips on a relative basis did not. And any cash that we held would have been a drag. Management effect, high yield and U.S. equity both stand out to the positive side, and private equity detracted from performance. For the 3-year number, the allocation effect is virtually flat. There are some asset classes that had slight overweights and underweights that helped, but the largest impact was the cash that we held, which now goes back 2 and 3 years ago, and that was a detractor. And for the management effect, private equity is the largest detractor and number on the page. Overall, the 3-year number was 11 basis points behind. The summary of these and the breakdown for each of the numbers for allocation and management effects, so how we did because we were overweight or underweight, or how managers did versus benchmarks, are shown there. My last comment before I turn it over to Seema is on page 15. How did NYCERS do versus other large public funds? Pardon me. NYCERS is the blue dot, and the return of 479 puts you in the 60th percentile. That's for the quarter. The 1-year period, the 1254, in the 55th percentile, just outside the median, and the 3-year number was above median, just outside the median on a positive way, returning 1050, and as you see, the 4 and 5-year numbers were above median, and the 5-year number of 839 is just outside the top quartile. So unless you have questions about the overall asset allocation and where we are, and again, Seema has some comments as to what we've done since then, since September 30th, which we'll go through later. I'm going to turn it over to Seema.
There was a negative story in yesterday's New York Post that I think was totally inaccurate. The gist of it would be if we had been totally in index funds, we would have done better. I'd like you to be able to comment on that.
Sure. 2 pieces to comment on. The first piece would be the return, if I'm referring to the same article. It referred to returns and it referred to index and the like. On the returns that we reflected in our CAFR, in our financial reports of, I believe, 12.1%, I could be wrong there, I believe 12-point-something%, are correct. And the article implied that we did not take into account cash flows correctly. The return of 12.1% absolutely takes into effect cash flows, and what needs to be understood is when those cash flows occurred, and because the cash flows occur, as you know, the city's putting in overall for the entire, I'm using the city now, $8 to $9 billion a year. Those cash flows don't happen in one day. They happen over time, and because they happen over time, we're earning, and the market went up during the year, we're earning money on those cash flows. And so there were some faulty assumptions built into the return that was suggested was the correct return, which was not the correct return. The other item is related to the
Index fund.
index, and that is, quite frankly, a very simplistic analysis for the simple reason that it assumes it's effectively data mining. You're taking and looking, going back and saying, what would have been the best return that we could have gotten for the cheapest price, knowing what we know now after the fact.
Right.
Also,
Clearly,
in downturn, had we been in that.
And so,
Right,
in
cream.
an upturn, obviously, if we had more money simply in U.S. equity, we would have done better. But having said that, what would the returns have been in a downturn such as 2008? It would have been disastrous. But there's a much more important piece to this, which is this does not diversify the portfolio. Obviously, it's only U.S. equity. It's only large cap U.S. equity, referred to with the S&P 500. And moreover, for fixed income, it's referring only to the, I believe, the Barclays aggregate, which is core fixed income, which is yielding in the 3% range. And to suggest that we should have 40% of our portfolio knowing that interest rates are likely to go up, and even if interest rates don't go up, that will earn 3%, will, as Bob North clearly can explain, will guarantee that we do not achieve our expected return.
yeah, it clearly wouldn't be prudent for NYCERS to put all of their money in U.S. large cap equities and bonds
And,
in this environment or any environment.
and in bonds, the worst part or the most risky part of the bond index given the expectation for interest rates.
Thank you for the information.
Why would we want to take investment advice from the New York Post?
Well,
John
actually, it's the former executive director of NYCERS who was giving the advice.
I'm just answering a question.
Any other questions before we move on? Okay.
Okay.
So we'll move into equities. If you turn to page 19 in the quarterly book. So on page 19, this goes through NYCERS U.S. equity returns relative to the benchmark. So it's about 39% of the total funds. And what's interesting is that you should have put all the money into small cap U.S. Then you would have done even better.
That would have been a better article.
That would have been better. So anyway, so the trailing 3 months numbers, the quarter, as Martin mentioned, the Russell 3000 was up about 6%, a little over 6%. So the absolute number is strong in the quarter. And in the trailing 12 months, the absolute number is quite strong too, close to 22%. NYCERS has done even better than that, and there were two reasons behind that. One, we got the asset allocation correct in the case where the board approved going overweight to small cap, overweight to mid cap, and underweight to large cap versus the Russell 3000. In addition, our active managers did well, so the combination of getting the asset allocation right and the active managers doing well helped us put up some really great numbers. So just to give you an example, over the last 12 months, small cap itself, the index, was up 30%. That's a big number. NYCERS was up 34%, so an outperformance of 400 basis points. Mid cap, we're all passive in mid cap, so call that in line. In large cap, the index was up 21% for the last 12 months, and NYCERS was up 25%, so 400 basis points of outperformance there. So that's just to give you an example of what's happened.
Is it again, the passive index outperformed the benchmark?
Large
cap? No, okay.
No, I was comparing the benchmark, the index, to our active managers' performance.
Oh, active, okay.
Yeah. So in the case of small cap, our active managers outperformed the index by 400 basis points. And in the case of large cap, our active managers outperformed the large cap index by 400 basis points.
Oh, okay. So we had active large cap managers.
That's right.
I thought that was all passive.
Yeah, exactly. That's topic for another conversation. So if you turn to the next page, 20, this goes through some more detail of how the U.S. equity is broken out. And as you can see from the pie chart, over 80% of the dollars in U.S. equity is passive. So if you look at the couple columns down below, the index return, the actual return, the difference column, just going to what Martin had mentioned earlier, so the small cap Russell 2000 index for the quarter was up over 10%. The mid cap, the S&P 400 index, was up over 7%. And if you look at the Russell 1000 index, which is more large cap, that was up about 6%. So you're seeing the differential there in the quarter as well between small, mid, and large. And that just goes to the asset allocation that we just talked about. So if you then turn to page 27, we'll go through international. So here in the pie chart at the top left, just the opposite basically to how we're set up in the U.S. equity allocation. So nearly 80% in international is active versus passive. And again, if you look at the couple columns, the index return, actual return, and difference column, so I'll point out EFA passive was up over 11%, as Martin mentioned. And then for some reason we have stars in the passive EM, but that was up about 6%. So we'll make sure that gets fixed. And I wanted to point out that you might remember when we did the new EFA search, we added an allocation, a new allocation to small cap EFA. And we thought it would add to the diversification of the portfolio and also add to the risk-adjusted returns of the portfolio. And just if you see here in the quarter, the EFA small cap was up nearly 15% in the quarter. So it's a big number. It's a small allocation for us, but nonetheless, it added a lot of good return to the quarter. So if you then turn to page 28, let's go through some details on EFA. So it's about 9% of the total funds. Again, as we discussed, the absolute returns were strong in the quarter and also in the 12-month period, where the index was up close to 24% for the 12 months. Now, the new EFA search, we just funded those managers in May of this year, so some of this is now coming through in terms of the outperformance that we would expect. So if you look into the quarter, you'll notice the blue bar is the active equity managers, the yellow bar being the index. So slightly outperforming in the quarter. And again, it's early days, so we would expect to see better outperformance going forward from our managers. If you then turn to page 36, it's emerging markets. So about 6% of the total funds. So the absolute numbers here are very different versus U.S. and developed markets, as Martin mentioned earlier. So in the quarter, up about 4% for emerging markets. Our portfolio is roughly in line with the benchmark. The trailing 12 months looks very different, so negative numbers now you'll start seeing, although our active managers outperformed, so they were slightly positive. Which is a good thing. So, and we'd start to see, hopefully, as in the macro environment, things sort of settle down. We've had a bumpy ride along the way. The emerging market equities now arguably are quite cheap, and so more people are starting to talk about allocating money there, and I think we're set up well. We're already at policy, so I think we're set up well for seeing some improvement in emerging market equities. It's a long-term play, though. If you then turn to the next page, 37, this is a hedge fund portfolio, about 3% of total funds. The approved allocation is 4%, so we're still making our way there. And here you'll see in the quarter and in the trailing 12 months that we're slightly behind our HFRI plus 1% benchmark in all those periods. A little bit ahead in the trailing 12 months with our one-year T-bill plus 4%. But generally what's going on here is, which you're all well aware of, is we've been trying to balance this portfolio as quickly as we can, meaning getting more return drivers into the portfolio. So we've been underweight more equity-sensitive strategies in our hedge fund portfolio, which is why in a year like this year, we're slightly behind these benchmarks because we're much more skewed toward these diversifiers. But the idea has always been to go out and find more return driver funds. We have found some. We expect to bring a few to the boards in the upcoming months so that we can then get to more of a balance, which is what we've talked about doing. So if there aren't any questions for me, I'll turn it back to Martin.
Thank you, Seema. So page 39 shows the total mix of assets for fixed income, and as you see, more than half is in core fixed income, and that's broken down further on the next page through the top pie chart and charts on the bottom, where you see that in the over-underweight column, which I've been pointing out the last several quarters, we're underweight the government sector and we're overweight the spread sectors. That decision in an environment of rising rates has helped. As you see, the lowest return, in fact negative returns for treasuries and positive returns, although modest returns for the other sectors, and each of the sectors added value. And numbers are shown on page 41, and while the numbers are positive, they certainly do not compete with Seema's returns, but these are numbers that we're going to have to start getting used to in core fixed income. For the quarter, it was 0.83%. That was 20 basis points ahead of the benchmark. But you'll see the one-year number is negative, of minus 139. And a very important point that I want to bring out is that while the number was negative, it was well ahead of the benchmark by 93 basis points. And to be ahead of the benchmark, I think I brought this up last quarter as well, to be ahead of the benchmark when you're experiencing absolute returns that are negative does help a lot. The long-term results are good and well ahead of the benchmark as well. TIPS, because they're similar to treasuries, have larger negative returns for the one-year period. We were ahead of the benchmark. All three of the managers outperformed, and the returns, because of the negative 582 for the last 12 months, while ahead of the benchmark, have drawn down the longer-term results to the 5 to 6% range. And high yield, or enhanced yield here, high yield has lived up to its name on page 43. More equity sensitive, riskier assets, for the quarter returning 246, 60 basis points ahead of the benchmark, and a very strong return for the year, returning 786, over 200 basis points ahead. And as you see, 5 years over 12%, and even 10 years, 8%, each of these very well ahead of the benchmark. So the program's done very well, and as you know, we restructured the program a little over a year ago. Convertible bonds, even more equity sensitive on the next page. So in blue, you see the program returns. So for the quarter, 434, and for the one-year period, 1354. You'll notice the primary benchmark, we're well behind that primary benchmark, but you'll also notice that the maroon color, we're ahead of that benchmark, and let me explain to you what that is. The two managers that we have, one was ahead of the benchmark, one was slightly behind their benchmark, but the overall effect was that when you take the weighted average of their individual benchmarks, they were ahead. So for instance, 434 versus 385, or 1354 versus 1266. But in a bull market where equities go up and convertible bond prices are very much dependent on how sensitive the individual securities are to equities, or the underlying equities, as the delta or as the sensitivity gets higher, what happens is you can have names in the index that are 2-3%, that because the underlying equity does very well, and in a bull market that's what happens, you can end up with names in the benchmark that are nearly or above 10%. We've been speaking to the benchmark providers to cut that back because our managers, to manage a portfolio prudently, are not going to own names and let it ride up to 10% or higher. They're going to cut it back, and they're cutting back names prudently, but those names stay in the index and keep going up. And so in a very strong bull market, it's not unusual to underperform the overall benchmark, but as you see versus the maroon, they're actually doing okay versus their individual benchmarks. And also, as you know, earlier this year, we restructured a piece of the convertible bond program as well. But on an absolute basis, the returns are very good. And talking about absolute basis,
Hey, Mark?
yes.
So why would we put in the broader index? We have a custom index, that's what we should be focusing performance relative to our custom index.
Right.
And not confuse it with,
I think
this sort of market index that we really shouldn't care about.
so as time
Other than
goes,
say, boy, I wish we had those returns.
so here's the answer. The answer is you're right. These are very imperfect benchmarks, and they're not really investable in the way as I described them. But over a market cycle, and unfortunately the market cycle, because the market's gone up for 5 years, you have to go out 5.5 years to get the full market cycle from 2008, you see that it starts flattening out. The reason we're still underperforming, however, in that 5-year period is because we had a manager who's no longer a manager who was significantly underperforming. But since then, the program, we're fine with the program. You are right. We possibly should have a conversation about the overall benchmark and maybe switch around primary versus secondary benchmarks. I can point out to you that historically, a similar thing happened in high yield in 2005. The autos at that time, GM and Ford, and their finance subsidiaries were downgraded to below investment grade. And at the time, because of the downgrade, represented more than 15% of the overall high yield benchmark. Well, high yield managers, because of diversification rules and our own guidelines that prohibit them from owning 15% of anything, they underperformed. And so we adopted, as you'll see if you turn back to the high yield page, the benchmark that was called the capped benchmark. And the capped benchmark effectively is the same benchmark, but it says if an issuer is more than 2%, it's capped out at 2% because it's more investable that way. So you have the full universe, and then you have the capped, more investable index. The problem with convertible bonds is such benchmarks have not really hit their stride. They're not really published. Part of it is the benchmark providers. It's a much smaller universe, and we can have a further conversation about this.
Yeah, I think to David's point, we may have to switch.
We can switch
primary
switch them around. And we can have a conversation about that. But your point is well taken. Opportunistic fixed income did very well for the quarter, certainly for the year, returning nearly 17%. The 10% is what we're looking for. And for the 3 and 5 years, also doing well versus the 10, underperforming a high yield universe. Of course, it's not managed directly versus the high yield. That's why it's the secondary benchmark. And also, over that period of 3 and 5 year period, you have things that have run off the portfolio versus now things that are now becoming more important in the portfolio. The next 2 pages, Core Plus, which is LM Capital, a developing manager, you see has done very well. And the following page, Emerging Manager, which is Progress, was 10 basis points behind, but over the other time periods, over the 1, 3, and 5 year period since they restructured the portfolio, has done very well. So unless there are questions, I'm going to turn it over to David Morris for ETIs.
Good morning. I'd like to turn your attention to the board book with the flat binding, page 13. Page numbers are a bit difficult to read. We apologize for that, but it's the page that immediately precedes the cover page for private equity. This book here. Page 13.
We have extra copies if you don't have the book.
On page 13, you'll see that the NYCERS ETI portfolio outperformed its custom benchmark by 15 basis points. And PPR did also very well in the third quarter, beating its benchmark. Turning to the first 2 pages of the ETI report relative to PPAR. In the third quarter, NYCERS purchased $5.9 million in loans to create or preserve 279 units of affordable housing. The program also committed to purchasing $9.1 million in loans covering an additional 276 units. And in the third quarter, the PPAR program took advantage of its expanded geographic target area, which enabled us to make additional commitments there. At the end of the quarter, the value of the PPR portfolio was $219 million. With that, if there are any questions, I'll turn this to James Delgado.
Perhaps the next time we meet for this type of report, the print will be brought.
Yes, I agree. Okay.
If I just have one question. In reviewing, the PPAR and the other documents regarding this, I see there still seems to be a lack of representation in some of the outer boroughs, and I'd ask that your office and the Comptroller's office look to see if they can find ways to expand it so that all the boroughs are represented on these and not disregarded.
Absolutely, we do look to do that, and we're hoping that with the expansion of the program, that we're looking to bring more product in.
Okay. Thank you. That's all. It's been a continuing comment of mine every year or two. I just remind you.
Good morning, everyone. I'll be walking you through your private equity quarterly report for the quarter ending June 30th, and that begins on page 18 in the large agenda package. I'll give you 1 second. So, since inception through June 30th, the program has committed $7.2 billion to 152 partnership investments across 101 various GPs. Your market value was $3.6 billion, which represented approximately 7.8% of total planned assets as of June 30th. So within your target allocation of 7% plus or minus 2%. Your unfunded commitments were $2.4 billion, resulting in a total of exposure of approximately $6 billion. I will add that during the quarter, both your since inception IRR and total value multiple increased. Your total value multiple was 1.31 times, and your since inception IRR was 8.6%. On the top of the next page, page 19, we'll look at your program's since inception returns versus the various benchmarks. And as you can see, as of June 30th, your since inception IRR of 8.6% underperformed the program's benchmark. The primary benchmark is the Russell 3000 plus 300 basis points. And I'd say this underperformance was largely driven by the strong performance of the U.S. stock market and the fact that these gains can take some time to get reflected through your portfolio company valuation. So, the lag nature of the asset class, I think this will correct itself over time. But I will add that your program did outperform the industry median by 450 basis points. If you look to the bottom of that page 19, the portfolio remains diversified by strategy and geographic focus. We're going to turn ahead a couple of pages. If you could please turn to page 29, where we will look at some of your quarterly highlights. First, 29. So first, the portfolio was cash flow positive to the system during the quarter, generating a net cash inflow of approximately $88 million, and this is up from both the prior quarter and the prior year period. Next, during the second quarter, the portfolio's valuation increased by approximately $104 million net of cash flows. I'll highlight one manager that was largely attributable to this. That was Catterton Fund 6, which over the quarter was up 34%, representing approximately $16 million of that $104 million gain. And the valuation has increased $372 million over the year ending June 30th. Next, we'll look at some of your new commitments over the quarter. During the second quarter, the program closed on 7 new investments totaling $390 million in commitments. And subsequent to quarter end, the program closed on 2 additional commitments for $30 million, both in the EM 2012 program. Now please turn with me to page 32, where we will continue to look at your performance. So we already looked at your program's since inception performance versus the various benchmarks. The only difference here is that the table below presents these stats over multiple time periods. So if we could look at the bottom half of the page, your investment returns here are broken out by strategy and sub-strategy, and you will see that secondaries, large buyout, special situations, and growth equity continue to be driving your program's performance. I'll highlight a couple of names within your special situations portfolio: Ares, BDCM, which is Black Diamond Capital Management, and Platinum Equity, a newer commitment. They're all performing very nicely. Within your secondaries portfolio, AXA, which has been rebranded as Ardian, is performing very nicely. Lexington and Landmark are also performing very well. Within your growth equity portfolio, Vista and Pinebrook are driving those returns. If you could please turn to page 35, we'll look deeper at the portfolio's diversification. So as you can see, the portfolio is highly diversified by manager, with 19 managers comprising $3.2 billion, or approximately 54% of your total exposure. I should also add that for a majority of these managers, you are committed across multiple funds, across multiple vintage years. So it is nicely diversified. And on the next two pages, we'll look at your cash flow activity by year and quarter. So on the top of page 36, you will see your cash flow by year, and you'll notice that in 2012, your program became cash flow positive and remains cash flow positive year-to-date 2013. And this is largely a result of your maturing portfolio. I mean, your program started back in 1998, but you continue to increase commitments through the 2000s, and obviously distributions may have slowed down through the financial crisis, but as the market environment has improved and liquidity has come back with debt markets opening, your managers have been taking advantage of those opportunities, and we're seeing a lot more. It's been a seller's environment, and we're seeing a lot more distributions. And then on the top half of the next page, 37, it's the same information, just broken out by quarter. So that's really it for my prepared remarks. Unless there are any questions, I'll turn it over to Yvonne for real estate.
Thanks, James.
Good morning. So, real estate immediately follows the private equity report in the board book. I think it's page 46. You'll see that the black and white version of the real estate performance report for the second quarter has a dark upper right corner, so I'm going to be referring to the page numbers down on the bottom. So page 1 on top, it says New York City Employees Retirement System. It's the executive summary for the second quarter for the NYCERS real estate portfolio. And just to kind of give you a backdrop before we talk about the portfolio, just on the market conditions with respect to real estate, at last some sustained signs of recovery in commercial real estate as gauged by improved investor sentiment. You know that we've been talking about this real estate recovery since 2009 here in the U.S. It starts, it stops, but at least here in the U.S. we definitely have some traction here. Also seeing some early signs of recovery in Europe. You know that we've been bringing investments relative to opportunities in Europe, particularly in the UK. In Asia, there are some positive signs in Japan. And one of the metrics that we can look at to kind of evidence this increased confidence by investors is the transaction volume that you see globally in real estate. So just in the second quarter, there was about $120 billion of deals in commercial real estate, which was an increase of 10% from the year before. And hopefully, within the next couple of weeks at year end, it's forecasted that global real estate deals will reach about the $500 billion mark. So that's really, really positive. What you kind of see now in terms of what investors are buying, you know that when there was first signs of recovery, people were looking for safety. They were going to prime cities, they were buying core real estate, they were looking for strong income returns. Well, now that folks are a little bit more comfortable, investors are stretching for that yield, and where they're looking in secondary cities. They're also looking at value-add strategies, and as you know, we have a portfolio that's comprised of core and core plus and non-core, or what we call opportunistic strategies. So we have managers all across the field trying to execute that on behalf of NYCERS. So just to try to drill down into the performance for the quarter, for the second quarter, you know that we have a 6% allocation to real assets here at NYCERS. And right now, in terms of real estate, we're 4.3% funded. That equates to about $2 billion in market value, real estate in the ground. We have about $550 million in commitments that we have yet to fund. So in terms of our total exposure to real estate, that amounts to about $2.6 billion in activity. We talked about, I mentioned the fact that we have about 40 investments in real estate that's being executed by close to 30 managers. And in terms of what they've been able to deliver for you for performance, let's look at the quarter. So I'm reading along the left-hand side of the page in the net returns section. So we're going to be talking about the performance of the NYCERS portfolio over an extended period. Starting out with the quarter, though, we're at 3.9%, which is kind of right on top of the benchmark at 3.9. For the 1 year, we're at 12.6%. For the 3 year, 17.4%. Our since inception return on a time-weighted basis is 6.1%. And our overall since inception return, IRR for the real estate program, is 4.3% and a 1.2 times multiple. I have to apologize that the performance on the
1 year and 3 year versus the benchmark returns? What were they?
We were ahead, we were slightly under, as I mentioned, for the quarter at 10 basis points.
Right.
We were ahead 40 basis points on the 1 year,
Right.
and we are 240 basis points ahead on the 3 year.
Great, thank you.
Yeah, I was just about to say I apologize because the bar graphs didn't come out too well on black and white, and I will adjust that. But since I'm an honest person, I'm going to tell you, yeah, we exceeded our benchmark for the 1 year and the 3 year. For the 5 year, that incorporates the full brunt of the global financial crisis, and we were under about 370 basis points. Overall, since inception, we're under 100 basis points.
Okay, I see the
Yeah.
benchmarks there.
Yeah, so we'll make sure that that's, very easy for you to discern the next time that I come around with this.
Largest one.
Pick yellow
Yeah.
for the other bar.
I picked yellow. Yeah, so I do apologize for that. Looking at some risk metrics for the portfolio, we talked about the fact that we're about under 100 basis points overall, so we're under there. But other metrics that appear in our IPS as it relates to regional diversification, investment size, manager exposure, and leverage were all within the metrics that were established in the IPS. And actually, these are just the highlights. There's a more detailed analysis on page 8 of this report. In terms of investment activity for the second quarter, we committed to an industrial specialist. We also, since that time, closed. We've also committed and closed on Divco West 4, which is the office specialist in tech markets. and Blackstone Europe 4, we committed to and closed. So overall, to date, we're about $210 million in terms of new commitments and closed for toward the fiscal year for NYCERS in its real estate program. On the yeah.
What the inception date is, just so as a point of reference.
Yeah.
Or it's probably there in yellow as well.
I will do that. Actually, I think the last page of the report is a FOIA, which has a column of first drawdown, and you'll probably have to hunt for it, but I think it's Canyon Johnson at December 2002. But we'll make sure that that's a lot easier to find in the next report, so thanks for that. We'll take care of that. On the next page, which is labeled number 2 at the bottom, we're just going to review the portfolio construction. I referred to the IPS, and in terms of the strategic diversification that we're seeking in the portfolio, it's divided up between the core plus component, where we're looking for stable returns predominantly from income, and then the other component of the portfolio is comprised of managers and partners pursuing non-core or opportunistic strategies, where the bulk of the total return is coming from appreciation. And for the second quarter, we'll look at the NYCERS portfolio. I guess the relevant metrics from the page before is noting that we have a $2 billion in the ground, about $550 million in unfunded commitments for a total exposure of $2.6 billion. This graph, the circle graph at the top of the page, shows you how the portfolio is broken out, and we are exactly at 40% core plus, and 60% in non-core, in keeping with our portfolio construction and our investment policy. The following page, that has page 3 on the bottom, is a more granular look at the quarterly performance and how those core plus managers perform and how those non-core managers perform. And just to summarize, for the core plus sector, where we have about 11 investments, those investments return 3.6% net. And what was driving that predominantly was Heitman, which is an open-end core fund, and also Prologis, which is an enhanced industrial specialist. Looking to our non-core managers, of which we have 25 investments, they delivered a 4% net for the quarter, and that was driven primarily by Blackstone 7. The next page has page 4 at the bottom, is a great visual, again, a continuation of the conversation, drilling down into the quarterly performance. You'll see that, again, if you look at the attribution diagram here, those investments to the right are your outperformers, and to the left of the line are your detractors. Again, I mentioned to you that your top performers for the quarter are Blackstone funds 6 and 7, and also Westbrook 7. And there's some narrative regarding some, highlight events from those 3 funds. Again, this is a drill down into the quarter, but real estate is a long-term investment. Our investment cycle is actually 10 years. So, I mean, what happens in a quarter may or may not move the needle. And for some more details on longer periods, on page 10, you'll find the same information for the 1 year and the 3 year. So I just want to kind of keep things in context. On page 5, again, another do-over for me, because you can't see what the Odyssey is. But again, in real estate, we try to diversify the risks that we're undertaking by incorporating diversity both in property type and also by geographic diversification. And if there's any other comments or questions, I'd be happy to take them. There's more details of everything that I just talked about in the following pages, and we'll do better with the shading. Thanks so much.
All right, so that completes our part of the quarterlies, and now Callan will go through their review.
Great, thank you. The Callan report starts on page 57 in the board package, but there's also a handout in color with a green cover, and I'll use those page numbers as I walk you through it. So as you know, we've been doing this now for the last 2 full years. Page 2 starts with the snapshot look at the asset allocation versus the long-term target asset allocation. It also gives you an idea of how your asset class targets compare to others in the database of large public funds above $10 billion. And just looking across the various asset classes, you see that your target for domestic equity is about median, but your actual is top quartile. For domestic fixed income, which for you includes a lot of things besides just core fixed income, but there you see that your allocation is top quartile versus others, but again, it's because of the addition of high yield tips and opportunistic fixed. Real estate is basically about median. International equity is below median versus peers. And your alternative bucket, which is a combination of hedge funds and private equity, is slightly above median on that basis. Page 3 gets into how we calculated the interim target. As you recall, back 2 years ago, right after we did the asset allocation, a number of your asset classes were not fully funded. So we developed the interim target based on where we were at that time, and then the holding positions for the asset classes that needed to be filled. So the next few pages, starting on page 4, are attribution analysis, similar to what Martin walked you through. Page 4 shows the total fund versus the long-term target. Slightly better performance versus the target index, and what helped was the overweight to domestic equity, the underweight to the core plus 5 and tips, and strong performance in domestic equity. What hurt was underweight slightly to international equity and weak performance in international equity and hedge funds. Page 5 takes the same analysis but looks at the interim target. And for this quarter, it's basically the same. The long-term target and the interim is only a basis points different. So the same reasons for what helped and what hurt versus the interim for the quarter. Page 6 and 7 show the 2-year attribution analysis. On 6 is versus the long-term target. You're ahead of that target, 1477 annualized versus 1442. The managers added 31 basis points in the aggregate, and there was a slight asset allocation effect of positive 5 basis points. What helped was the overweight to domestic equity, the underweight to core plus 5, tips and hedge funds, and then strong manager performance in domestic equity, core plus 5, and real estate. What hurt or what detracted some value was overweight to short-term cash and private equity, underweight opportunistic fixed and international, and then weak performance in opportunistic fixed income, international equity, and hedge funds. Now, this is the opportunistic reflects that the underweight to that asset class was a negative 18 basis points of underperformance. Page 7, the 2-year number against the interim target. Similar reasons for outperformance and what was detracting from value, but the main drivers were the overweight to domestic equity and underweight to fixed income, and strong performance in domestic equity, core plus 5, and real estate. Page 8 and 9 look at similar peer comparisons to what Martin had shown. You see here against the total large public database on an unadjusted basis shows that the quarter 1 and 2 years were around median, with the 2-year number since we've instituted the new asset allocation in the 43rd percentile, and as we discussed earlier, ahead of the long-term target. The 5 and the 10-year number also ahead of your, the 5-year number is slightly below target, but 34th percentile, and the 10-year number is a 59th percentile, but ahead of target. On page 9, we do a asset allocation adjusted ranking. So here we say, well, a lot of what drives your relative rankings is asset allocation, but what if everybody in the database had the same asset allocation as you? So it's more of a focus on your manager performance. And here actually your numbers improve, and the last 1 and 2 year numbers move up to the 17th percentile, and the 5 and 10 are around the 30th percentile. Page 10 is, again, looking at total fund peer comparisons, but here on a calendar year basis. What you see is that the NYCERS total fund ranked above median in each of the last 6 calendar years. This current year that we're in is only 3/4 of the way done, but also above median over this period. You also see the risk statistics at the bottom of page 10. Standard deviation below 0, downside risk in the 3rd quartile. Tracking error also very low, down in the 4th quartile. Next few pages are going to break down by various asset classes. So as Seema talked about on page 11, here we have total domestic equity versus peers and the benchmark. At the total domestic equity level, there's a good amount of index funds, so your overall return looks very index-like. However, the last 1 and 2 years are ahead, and we'll see what the drivers were when we look at the active side. But for most periods, it's been pretty much a median-type performer overall. Page 12 shows the total domestic equity versus peers on a calendar year basis, along with the risk-adjusted measures that are also very median-like compared to peers. On page 13, you have the total active domestic equity. So this is the composite of just the active managers in domestic equity. And you see that the numbers are very strong over the last 2, 3, 5-year periods. And as Seema pointed out, the overweight to small cap was a positive, but also the fundamental index managers have added significant amount of value over the last 3 years or so. So the actives managers are doing well in domestic equity space. Page 14 has the risk measures and the tracking error for the active managers. You see the graph there with the rolling 12-quarter tracking error. There has been some higher than average tracking error since 2007, but you have been compensated for that higher tracking error, therefore been positive tracking error. And a little bit more volatility, again, from the other risk metrics, but again, you've been compensated for that volatility. On page 15 is the total international equity. As Seema mentioned, with underperformance coming from emerging markets in general, with our allocation to emerging markets that is slightly higher than peers, and also versus the equity benchmark, you see that underperformance versus the benchmark and the peer group. We've also changed managers in the last year as well. But this area of the market, we have seen underperformance over the last 3 and 5 years versus peers. Page 16 has calendar year performance for international equity and the risk measures all showing that the below average as far as risk-adjusted measures and information ratio, sharpness ratio. On page 17 is now just looking at the active managers within international equity. And you see here that we are ahead of the benchmark, which shows that the managers are adding value. However, versus peer group, again, with an overweight to emerging market, has hurt the rankings over the last couple of years. Page 18 has the risk measures, also the tracking error rolling over 12 quarters. And you see here that we have a below median tracking error for international equity within the active space. Starting on 19, we're looking at just the fixed income asset class, and here we are including all types of fixed income. So it is the core plus 5, the high yield, the tips, and then the opportunistic. And again, because fixed income has a big chunk of the area that we're still getting fully funded, there is a long-term target and an interim target. And here on page 19, we're showing the fixed income composite versus the long-term target. And performance is very good, slightly ahead of the benchmark, and ranks very high for the quarter. For the last 1 year is in the top quartile. Last 2 and 3 years, approximately in the top third. What helped was the overweight to high yield, the underweight to tips, and strong performance in high yield and opportunistic fixed. Page 20 has the calendar year performance and the risk-adjusted measures. Here you see the very strong risk-adjusted performance in fixed income area versus peers near the top quartile. You see that on page 21 then, when we look at the rolling tracking error, as we've added more to opportunistic fix, the tracking error has increased, but for a longer period of time there, you have had a much lower tracking error than your peers. And then 22 is looking at the fixed income versus the interim target. Performance looks a little bit better because the interim target was less than the long-term target. However, the rankings are exactly the same against the peer group. The risk-adjusted measures also on 23 and 24 are also very strong. There is one page that the chair had asked us to include in this book that we have not yet been able to put in here. It's more of a forward-looking risk page at the total fund level. It's basically almost done, but we're trying to customize it to NYCERS because NYCERS has some customized asset allocation projections that are different than our normal projections, as you know. So once we get that to be into the system, we'll have it hopefully for next quarter.
Any questions for Callan? Okay, thank you. And then I think the last item is the monthly for October.
Okay. So if everyone could take out their monthly performance color book. And if you turn to page 34, we'll start with the October numbers because it's the October monthly report, but I'll update you on what happened in November and currently what's going on a little bit in December so far. But if you look on this page 34, October was a very strong month. The Russell 3000 up over 4%. The EFA index up over 3%. The emerging markets up close to 5%. Corp plus 5, which is down a little bit below, up over 1%. High yield up about 2.5%. And tips up about 55 basis points. So a very strong October. So let me just give you November numbers along those same metrics. So the Russell 3000 in November was up 2.9%. EFA was up about 80 basis points. Emerging markets was down about 1.5%. Core plus 5 was down about 60 basis points. High yield was up about 30 basis points. And tips down 1.2%. And then into December to date, just give you a sense for how it's flipped a little bit. Russell 3000 is down about 90 basis points. EFA down about 3%. Emerging markets down about 3%. Core plus 5 down about 40 basis points. High yield up 20 basis points. And then tips down about 90 basis points. So what's been going on? I'm sure you all have seen a lot of the news. So we had a strong November, up about 1%, let's say. U.S. stock market and developed markets were positive. Emerging markets were slightly negative. You had a bit of this bumpy ride, though, because you had the European Central Bank cut rates by 25 basis points, which was a surprise to everybody. But then in the U.S., we had strong economic data. So given that, as Martin mentioned earlier, we had a lot of concern or noise around when is the Fed going to start tapering their bond buying program. And given that, it was a bumpy ride in November. Now that continues into December, which is why you're seeing some of these negative numbers so far month to date. The fact that we got a budget passed, it wasn't maybe what everybody wanted, but we did something in Congress, so that was a good sign. And then the market every day just seems to decide what's relevant and what's right and what's good and what's bad. But, we're riding through it, and we've got a couple weeks more to go in December, so it'd be good to turn that around into a positive. But so far it's down a little bit in December. So lots to come ahead. So if you then turn to page 30, talk about our asset allocation and how we're set up. So as you can see here, the green bar to the left is U.S. equities. The blue bar to the right is Core Plus 5. So what we've done in November is we took advantage of the strong U.S. Stock market. We sold down U.S. equities. We bought Core Plus 5 in investment grade. And so now you'll see that we're within the ranges to where we want to be. And cash is roughly, again, low, about $300 million. So we're good there.
Can I just ask a quick question, Seema?
Sure.
So when you rebalance physically because we are breaching a range, do you rebalance back to the target, or do you rebalance back to a midpoint, or some other point along the scale?
Well, we rebalance, Martin can give you more details, but we rebalance back to within the range, and then we decide, should we be at midpoint, should we be at policy? But as long as we're within the range, we're comfortable.
So at this point, we still want to be overweight U.S. equity and underweight Core Plus 5 and tips, so we rebalanced at the target. So it was about a 1% rebalancing to get back to the targets for Core Plus 5, tips, and U.S. equity.
Balance the range.
The range.
I'm sorry, the range, yes.
Yeah.
And then, quite frankly, in December, just turns out the timing was good because when we sold equity, it was in early to mid-November when we were near the highs of the market. So that worked out because the equity markets have turned in the last week or so. That would have moved us a little bit further in balance. But it was not to the midpoint. It was to the a little bit inside of the range because of the preference to be still overweight equities.
Right. And I guess the downside of that is that you could be incurring more transaction costs than you otherwise would if you're in a strong bull market in a particular area where you're rebalancing
And
not to the midpoint or not to the target.
Yes. Sorry to interrupt you. And that's where the communication with managers comes in. So when you're moving money into investment-grade credit, you have to be able to make sure if you're moving hundreds of millions of dollars that The new issue market is there where they can put money to work. The market's open and functioning. Equities obviously are liquid, but also that we organize the monies that are moving from one place to another and will be invested as soon as possible. So there's the transaction costs, ultimately the largest transaction cost being the opportunity cost. Market impact costs can be high as well, but we want to minimize those as well. So the communication with the managers to know what's going on in the markets and what they can absorb on the buy side and what the transaction cost would be on the sell side is very important.
I'm just thinking back to some research that I saw come out of Callan, actually, on rebalancing policies and strategies in the past. And the research that I've seen seems to, I guess, advocate for a more systematic policy, more back to a midpoint or back to a target. But it's been a long time since I've seen that research. So really this is for my own educational benefit. I wonder if, Callan, if you have any more current research than what I might have seen 5 years ago?
There's anything published since then. But there's certainly more of a look at what the transaction costs are going to be for moving significant amounts of money back to either a midpoint or a target. So there's different schools of thought, but we typically see that you don't want to be outside of your range. You have a policy, you should stick to it. But as far as how much you get within the range is debatable for the transaction costs. But we do definitely believe in sticking to your policy.
So when's the latest research do you think that's come out on this topic? When was the last time you published?
Yeah,
I would just like to get a copy of it for myself.
what was the last? A couple of years ago, probably.
Yeah.
May have
Certainly
it
send you.
Okay. Thanks.
Okay. So if you would turn then to page 35 in the monthly book. This goes through the contributions to returns. And as you can see, the 1 month number, the October number, the total fund's up about 2.8%, the bulk of it coming from U.S. equities. And then if you look in the fiscal year-to-date number, again, this is through October, the total fund is up close to 8%, which is a very strong number. Now, if you add in what we think is about 1% in November, NYCERS is up nearly 9% for the fiscal year-to-date through November, which again is a very strong number. Now, December's looking a little bit negative, but again, we have a couple more weeks to go, and still very strong numbers for the fiscal year-to-date.
Yeah. Now, the Fed is going to meet shortly, right? Mark, big question as to what will happen. From what I understand, that's why the market went down, because the anticipation is that they will not keep doing what they've been doing.
Yeah, and that's where the back and forth has been going on in the stock market. For the very first time, actually, it was encouraging. I think it was last week when the strong economic numbers came out. Initially, the market reacted negatively, saying, oh my God, the Fed's going to start tapering, instead of saying, oh my God, the U.S. economy is getting better. That's a good sign. And then the market reversed in that day, finally recognizing it. And so that was a positive day. But as you mentioned, I mean, then you hear get the negative reaction. So it's a lot of back and forth. I think the fact that our Congress is still dysfunctional is a problem because there's still more decisions to come. There's not only the budget, which they're negotiating and close to doing, but then you have the debt ceiling raise negotiation all over again in February. So I think it's just anticipation around all these different factors.
Uncertainty.
Exactly. Yeah. So then page 27 just goes through the 12-month numbers for NYCERS. So over this 12-month period, NYCERS is up about $6 billion. And as of October, the end of October, the total fund's at $49.5 billion. We touched up a little bit higher than that, and then here we are now, as of December 12th, we're at $49.2 billion, so a little bit off that mark. The next page shows the 10-year numbers.
This is the highest we've ever been.
Yes, that's correct. So very good.
Intra-month was actually a little higher.
I know. We'll talk about that more.
Okay.
That's right.
Do you guys worry about, internally talk about, sort of the bubble question in the markets? The VIX is all-time low. Markets are getting correlated. It just seems to me that at least it's a discussion. I don't know. We can't be tactical, but to me there's some uncomfortable feelings that I hope you guys are just sort of mulling around as you talk. But it just seems to me that it's something worth
Right.
putting into your calculus.
Yeah, no, you're right. And we have talked about it internally. I think, though, when you look at, we've looked at a lot of data around the equity markets, U.S. and non-U.S., and I'm sure Callan has done the same. But those valuations aren't as stretched as the bubble days that we've seen in the past. They're certainly higher, but not higher than historical 10-year averages and 15-year averages. So even while it feels that way in particular in the U.S. equity markets, I don't think we're there. So that makes me a little more comfortable. We're certainly watching it, but then on the non-U.S. side, I mean, actually the developed markets are more inexpensive than they've been in a while, and emerging markets especially, given you've seen the 3-year numbers. Now they definitely have issues, particularly when the Fed starts tapering. They'll have more issues, and a lot of credit built up over there that's very unsustainable. So a lot of that, though, I think is reflected in some of those valuations. On the credit side, I think there's maybe an issue in high yield that we've been talking about.
So a couple of things in fixed income. It's an interesting dynamic because the tapering is really what folks are focusing on, and tapering would occur naturally. That based on what we experienced in June, if you were to extrapolate that means long-term rates go up. That doesn't necessarily mean that happens, but and equities go down. Our managers, because of this, are kind of stuck because do you take an aggressive approach, a longer duration approach, and say the tapering isn't going to occur, and then get whipsawed and tomorrow there's a surprise announcement? And so what's happening with many of our core fixed income managers, which is the bulk of the program, they're not taking many bets in duration versus the benchmark because of that possibility of surprise news happening that are unanticipated versus being able to change that and get out and preserve their returns. In high yield, and also if equities go down, we saw this in June, it seemed like every asset class went down, and the question then became, well, if everyone's selling equities and risky assets and high yield and convertible bonds and non-U.S. equity and selling treasuries, what are they buying? So at some point, it does create, and that's why July, August, and September went up and so on, because at some point, money's put in cash, and there's a lot of cash on the sidelines that eventually goes back into markets that are perceived to be undervalued. For high yield, while it is true that it is much more susceptible to higher rates because lower absolute level of yields means you have a higher duration. So back in the old days when you had a high yield bond of 9%, if rates went up, the duration was very low because you had the cushion of the yield. So if rates went up, you still had a great yield. Whereas today, if there's a 5% bond in high yield, it doesn't really live up to its name. It's not high. And so if rates go up, that 5% doesn't really protect as much as, say, a 9% bond. Having said that, because of the way the issuances have gone and the expectations, according to most market folks who project things, including our managers, default rates are expected to be extremely low. So even if rates go up and there's the initial reaction of selling risky assets such as high yield, the assets are for several years money good, because the companies themselves are not in any danger. I'm not talking about distressed companies, but the high yield market as a whole are not in any danger. So you can take a mark-to-market loss initially, but that's actually a buying opportunity in the short run, which is what happened recently. In fact, one of the pages we have in our economic charts show high yield spreads, and we're back down to below where we were before in spreads. So it really comes down to expectations of defaults. Do higher rates ultimately make it more expensive for companies to operate, and therefore have a higher probability of default, which will cause even more problems in the high yield market? So it's the back and forth of that. Our managers in high yield are much more optimistic, as it turns out, than our core fixed income managers, because core fixed income managers have just no cushion at all in yield, whereas high yield, while they have some cushions, less than before, ultimately the companies are in much better shape, generally speaking. So after the initial shock, when some equilibrium comes back to the market, the bonds that are owned, the vast majority of bonds that are owned, will be fine in high yield.
But that's, Callan's going to come back in February, I think, with their new capital market assumptions. And then we can have a more robust conversation about asset allocation, because we have some thoughts around that.
But those will be long-term assumptions, not the next 6 months.
Right. My conversation is based on what managers are telling us about what they're seeing today.
Right. Although I think we will want to talk about the ranges all over again, I think. So Jen, just lastly on this page 28, the 10-year number for NYCERS now is about 7.5%. And as of December 12th, again, we're at $49.2 billion. So if there aren't any other questions, I will turn it back to Thad.
Okay, any other additional items on the performance then?
We have nothing further.
Okay, great. So the third item on the public agenda today is the resolution that was handed out that you have before you on some past due dues.
Yes, Madam Chair, this is for NYCERS to pay dues to an important organization called NYCERS, which is part of the Investor Network on Climate Risk. It's an organization set up or affiliated with the United Nations, and as such, they aggregate a lot of important information regarding climate change, an issue that is of obvious importance, and we expect at NYCERS to tap more and more into the resources of that organization going forward as the issue becomes more and more important. And for that reason, I believe personally as a trustee that it's important for NYCERS to maintain membership, and as such, I would make the motion that we pay our dues and continue our membership.
Do we have a second?
Second.
Any additional discussion? I just have a quick question, and perhaps Karen, you can answer it for me. If you would just, since these are back dues that we're paying, could you just tell us what benefits we have received from this during 2012 and 2013, so that we understand what we're paying for?
Well, first I just wanted to give a brief, quick history about NYCERS. NYCERS was founded in 1989 after the Exxon Valdez spill to address sustainability leadership. NYCERS, or I'm sure it was all the city funds, but I know NYCERS specifically was one of the founding members of NYCERS, as they were in the lead on environmental and social issues. INCR was founded in 2003, which is a network of institutional investors, and they have several different areas that we have tapped into through the Comptroller's Office and with the Proxy Committee, and that is they have working groups which work on changes with corporations related to climate change and other sustainability issues. The Global Reporting Initiative, which asks companies to report on ESG issues, which we have incorporated into our RFP process over the past several years. There's also the annual Summit on Climate Risk and Energy Opportunities, which is every year in January at the UN. This will be the 5th year, and the new controller, Mr. Stringer, will be speaking at that initiative. So NYCERS has used both CERES and INCR to support its environmental and social responsibility, both shareholder issues and engagement with corporations historically, including the past 2 years.
Thank you very much. Is there any additional discussion or questions? All in favor?
Aye.
Any opposed? Okay, the motion passes unanimously.
Resolution number 1.
Okay. Any further business for the public agenda?
Nothing from the controller's office.
Okay, thank you. Then we need a motion to exit the public session and move into executive session.
So moved.
David, we have a second from Ray. Thank you very much. All in favor?
Aye.
Any opposed? Okay, we are in executive session. We just need a couple of minutes to, do you want to break down the camera?